Hi, everyone, and welcome to week 6 and our lecture for this week on taxation. Let's get started. So this week we are going to be covering chapters 17, 18, 19, 20, and 21. So several chapters in this week's presentation, this week's lecture. But the chapters are not so long, and they also kind of go with each other. So it's a general topic, and the topic is taxation, but most of the chapters kind of roll along one after the other. So chapter 17 is an introduction to taxation, right? And as we have done in the past, we are going to be focusing on the focus questions, right? So let's look at focus question 17.1. What are the 5 key attributes that a good tax system should have? Well, taxation is not an easy thing because it is by nature. Every time we look at taxes, it by nature it imposes an impact. It has an impact. It creates some kind of distortion. So we have to kind of understand that. We have to have that idea that no tax and no tax system will be perfect, and no tax will ever achieve 100% in every way, shape, or form, right? However, we can still try and find the least of the evils, if you will, right, as far as taxation. And how do we do that? Well, we think about these principles of taxation, what a tax should have, or what a tax it should exhibit. And the first one is efficiency, right? It should be efficient and try to minimize those distortions as much as possible. Second, it must be simple as far as the administration of the tax. So it has to have administrative simplicity so that it doesn't become a really burdensome thing as far as the collecting the tax, the everything that has to do with the imposing the tax, etc. So it has to make sense for the government to be able to administrate the tax. It also has to be flexible. And by flexible, we mean that it has to understand and be cognizant of the changes in the environment, in the economy, in the geopolitics and the national politics, and just the external environment in general. It has to adapt to the dynamic and the changing environment. It has to be politically responsible. So the idea here is to distribute wealth in the best manner possible, to try and reach a much more equitable allocation of wealth and resources than is in the economy. So it has to be politically responsible. It shouldn't be used as a political weapon or any kind of having a political interest necessarily attached to it. And then, of course, it should be as fair as possible, right? Meaning that those who are best able and should pay for the tax be the ones who are actually taxed. Okay, 17.2. What are the various ways in which a tax systems affect economic efficiency? So what are the ways in which tax systems affect economic efficiency? Many ways, right? It's not a simple question to answer because there's many ways that a tax system tax systems affect economic efficiency. But there are some ways that are more prevalent than others, more important than others. And that one of the ways is in the behavior, right? Economics is all about understanding how consumers and producers behave. So there's a behavioral effect of taxes. And this behavioral effect might be affecting work, for example, how much we value work and how much we desire to work versus leisure. How much education, right? The value of education, how much we educate ourselves, and then of course retirement. What kind of decisions we make about current work versus future leisure or retirement. What kind of decisions go into that? Then, of course, savings, right? Savings and investment. How much do we save for the future? Where do we invest, right? What are our alternatives for investment that make sense fiscally? And then, of course, how much risk are we willing to take in certain investments, in certain actions, in certain behavior? And then, of course, the energy devoted to avoiding taxes, right? And this is a big one because a lot of the problems with taxation is not so much the tax themselves, but rather the shirking of taxes, the cheating or trying to avoid taxes that ends up hurting the system and ends up being the real problem, not so much the tax themselves, right? And so you're trying to make a tax evasion and tax avoidance, you're trying to make it as less desirable as possible so that the energy devoted to avoiding taxes is not spent on that, but rather spent on working and other things, other activities that are going to promote and produce a much more efficient tax system. There's also the financial effect, right? Looking at financial structure of firms, for example, whether firms decide to finance their operations via bonds or via issuing stock, right? What kind of a financial structure they choose depends a lot on the taxation, on the tax burden imposed on corporations, right? Organizational effect, right? Corporations versus unincorporated enterprises. So do you go for a corporation type of a business, or do you do an LLC, right? Or even a partnership or a sole proprietorship, right? A lot of this depends on the taxes. What are the difficulties in determining what is a fair tax system? Not an easy question. Well, what is fair, right? And is it, for example, if you look at horizontal equity, if we seek horizontal equity, we're talking about treating all individuals the same, right? Is that fair? What about vertical equity, right? Treating those who are more able to pay differently. So should the better off pay more taxes, right? Because they're better able to pay taxes. Should the rich pay more taxes, right? That's that idea, right? How is ability to pay or benefit received or economic welfare to be measured? This is another question, right? How do we determine that? Because the fact that some people have money or wealth doesn't necessarily mean that they're happier, right? And so are they? Is the idea of a benefit received? Are they really benefiting from that, right? For example, if you have an estate, but the estate is just there and it doesn't really generate any kind of revenue for individuals because the estate is you can't sell it. Maybe there's no buyers for it. How is it generating a benefit to justify that person being taxed? How much more should those considered better off pay, right? So yes, if we come to the conclusion that those who have more should pay more, but how much more, right? This idea also that income is most often considered as basis of taxation, but it is an imperfect measure of both ability to pay and economic well-being is important, right? Because income is considered a basis for taxation, but is to what extent does it represent one's ability to pay and economic well-being? I mean, we might have We might make $100,000 worth of income, but maybe we have $120,000 worth of expenses, right? Maybe we have to take care of family members. Maybe we have several children, right? And so income is not always the perfect measure to determine how much a person should pay or not. And of course, we have the U.S. tax system does contemplate for some of these differences, and we'll talk about them later on in the presentation. What about treating consumption? Instead of taxing income, should we tax consumption? Is that fairer, right? And of course, what are the fair adjustments to income on the basis of taxation, taking into account things like health, marital status, and children, right? So those that, for example, have a physical limitation, right, or maybe some kind of a physical condition, like a handicap or some sort, where they might not be able to work, okay, a disability, and so those individuals, should they pay less taxes because of that, right? What about if you have a mental condition, like say, for example, you suffer from an illness, like say multiple sclerosis, for example? Should you then pay less, right? Should you be afforded better, more benefits because of that, right? What about those that are single? Should they pay less than those that are married, right? If you have children. And so all of these are different questions, right? And all come down to the question of what's fair, right? Okay, so that's chapter 17. Like I said, these chapters are long, are several, but they're very short. What is meant by the incidence of a tax? This is question 18.1. Let's look at it closely here. What is meant by the incidence of a tax? Why is it that those who ultimately bear the burden of a tax may differ markedly from those on whom the tax is legally imposed? So, incidence, we're talking about incidence. When we talk about incidence, we're really talking about who bears the burden. That's really the question. Okay? And who bears the burden is based on several factors, okay? For example, when we talk about a tax shifting backwards, that means that the tax is affecting a factor of production, say, for example, labor, okay? When we talk about a tax shifting forward, then we usually refer to this tax or the burden of the tax affecting consumers. A lot of times, the burden depends on the competitiveness or lack thereof of the market. So, a market where there are many firms, okay, will have a different impact on a market where there's only one firm, right? And this plays into the elasticity of demand and supply. So, for example, if there's only one firm providing a product or a service, right, the consumer necessarily has to pay that price that firm charges. And so because there are no substitutes, that tax will the firm will be able to impose that tax, include the tax, and the consumer will have to end up paying for it, right? Will have to pay a higher price usually because there is no option, there is no alternative. The demand for that product, right, will likely be less elastic than, say, for example, if there were alternatives in the economy where the consumer could substitute away from that product and go and buy something else. Question 18.2. What determines who bears the burden of taxes? How does it depend on the elasticity of demand and elasticity of supply? on whether markets are competitive or not? Might it differ between the short run and the long run? So we kind of answered this question already, talking about what determines how does it depend on the elasticity of demand and supply, and whether markets are competitive or not. What about long run and short run? Well, let's look at this graph here. The impact of a tax, say for example, if the government imposed a tax on bottles of beer, right? And so if you look at the demand curve and the supply curve before the tax, right, and that would have an equilibrium, or the equilibrium would be found at a quantity of quantity zero, and equilibrium price zero. So the price paid before the tax, say, is $1 per bottle, and then the government imposes a tax on bottles of beer. So the supply curve after the tax, you notice, right, that the supply curve shifts inward and to a quantity Q1 now, and at that supply, right, the supplier is unable to provide or to supply the same quantity, so the quantity is lowered, so the quantity supplied is less in the market. But notice that the 5-cent price paid by consumers, which is the price after the tax, right, results in the $1.05 results in price received by the firm of 95 cents, price paid by consumers of $1.05, which means that 10-cent differential is lost. It's what the government will end up taking from the tax on the bottle of beer, right? So the impact of this tax would increase the price of beer, which would reduce the quantity demanded and quantity supplied for beer. The consumer would pay a higher price for the beer. The producer would receive less revenue from every beer sold, and the government would take a percentage of that, or 10 cents of that, as the tax. Why are some taxes that appear to be markedly different really equivalent? And it all comes down, when we think about this question, we think that taxes are different, but in the end, they really they really have the same impact. And it comes down to incidence, okay? The incidence. And the incidence of a tax really describes who actually bears the tax, right? It does not depend on who writes the check to the government, for example. Okay, so for example, it makes no difference whether a commodity tax is levied on producers or consumers. Right, the tax is going to have an impact. It's going to have the same impact on the economy, regardless. Another example here: it makes no difference whether the Social Security tax or the payroll tax is paid half by the employer and half by the employee, or entirely paid by one or the other. The incidence is going to be on the economy, on supply and demand for labor, for example. So incidence then is that driving force, and in competitive markets, incidence depends a great deal on the elasticity of demand and supply. So, for example, if a commodity tax is not borne at all by consumers, okay, if the demand curve is perfectly elastic, all right? So think about this for a minute. A commodity tax not borne by consumers if the demand curve is perfectly elastic, okay? And that's because if you have a perfectly elastic demand curve, it means that any increase will result in the consumer moving away from that product and going to another product, right? Another alternative product, right? This is in a competitive market because you have many suppliers, many alternatives, right? In the same way, a commodity tax is not borne by producers if the supply curve is perfectly elastic. So again, here, if the supply curve is perfectly elastic, where you can get inputs of production from many other providers, right, then it will not be borne by the producers. On the other hand, it is borne completely by consumers if the demand curve is perfectly inelastic, where the consumer has no choice but to consume that product. Or by producers if the supply curve is perfectly inelastic, which again, where the producer has no alternative to the inputs of production that are being taxed, and hence he or she will have to bear that burden. So the question then, who bears the burden of taxation in the United States? So, like other countries, right, the U.S. has a progressive tax system. And what is a progressive tax system, by the way? It's a system where those that make more pay more, right? That's the definition of a progressive tax system. The more you pay, the more you make, the more you pay. And that's the U.S. tax system. But, okay, is the U.S. tax system, the progressive tax system in the U.S., does it really create that situation, that scenario, right? And this question has to do with the effective tax rate, right, as opposed to the tax rate that is imposed by law. So, for example, an individual might fall within a certain tax bracket, okay, but that individual may not necessarily be paying that tax rate. And the reason for it has to do with other factors like shirking, like getting around it, like tax avoidance, right? And it has a lot to do with those individuals who are better able to avoid taxes and not pay taxes. Those that are better able to do so are the ones that are going to benefit more from the loophole, so to speak, right? So here the question then, do the rich really pay more in taxes in the U.S., right? And we've heard this question thrown around many times. Are the rich paying their share? And a lot of folks perhaps consider that the tax bracket in the U.S. and the those that make more money should pay more taxes. But again, the question is, should we increase the tax rate, or should we try and figure out a way to reduce the loopholes that are reducing that effective tax rate? Because what's happening is it's not so much the problem of the progressive tax system. It's just that the system has too many tax avoidance loopholes where those that make more money and have more access to information and ability to avoid paying taxes end up paying actually less taxes than those at the bottom. Okay, Chapter 19. Chapter 19, Taxation and Economic Efficiency. All right. Let's look at question 19.1. How is the efficiency loss associated with taxation measured? On what does its magnitude depend? So to answer this question, it's all about the debt weight loss. Okay, so again, efficiency loss associated with taxation. Taxes are going to produce a negative loss of efficiency. Taxes by nature do that. It's impossible to not have that kind of an impact. So what is this magnitude? Now, since we understand that if we're going to have a tax, we're going to have that loss. So what does the magnitude depend on? Well, it depends on the magnitude of the substitution effect, which is the elasticity of the compensated demand curve. That's what this dead weight loss will be determined by. And what is this? What does this tell us, right? Well, to what extent can the consumer substitute away from buying that product or consuming that product because there are other alternatives? To what extent can the consumer do that and avoid the tax? Or to what extent can the producer substitute away from that input of production that is being taxed and substitute away from that and use another substitute or alternative, right? And so it has a lot to do with that. That will determine the magnitude of the loss. What is meant by the income effect and substitution effects of a tax? Why do they normally reinforce each other, right? For taxes on commodities, but they work against each other for taxes on wages and interest, all right? So we're comparing here income effect, substitution effect, and why do they reinforce each other for commodity taxation, but they work against each other for taxes on wages and interest? And this has to do with the nature of commodities versus, for example, wages and income. Okay, so if we're talking about the consumption of commodities, like say for example soda, right? If the government imposed a tax on soda, consumers could substitute their consumption of soda and consume a soda that is not taxed, for example, or consume something else that is not taxed. Maybe there's an alternative product. They could consume maybe juice or a product that was considered a substitute, right? So the substitution effect would take into effect, right? If there was an income effect, right? The income effect being that the price of one soda or one type of a product increased because of a tax, then you would substitute away from that product and consume a product that was cheaper relative to the other product. Therefore, the income effect would cause that substitution effect to take place. The problem with the reason that it doesn't work with each other for wages, for taxes on wages and interest, okay, has to do with the fact that you can't really substitute away from work as easily, right, as you can with commodities. Because if you think about work as an activity, right? So tax on labor goes up, for example. Taxes on labor go up. Well, you really don't have that many alternatives unless you have savings and are rich, etc. But if you need to work for survival, then you have to work no matter what. And so, and the increase in the tax for labor will not necessarily result in you substituting away from labor into something else. What may happen, and often does happen, is that it, in some cases, at some tax brackets and for some income levels, when taxes on labor increase, and you do have options like welfare programs, for example, where the individual can in fact be able to fill those needs that he or she has with alternatives, then you do have that income effect and substitution effect taking place. But that is not always the case at every single income level. There are some, you reach a certain level of income where increases in the tax will not cause you or allow you to simply stop working. So that's why it works against it when we talk about labor and wages, of course. How large are the efficiency losses associated with taxes on labor and savings? Okay, has to do with this effect of progressive taxation. Okay, so it has to do with the amount of hours that you're willing to give up working for leisure. So those hours, right, multiply times the wages. If those the bigger that those hours are, the greater the loss in today's term, the current term versus the future, right? If people decide that they'd rather not work because it doesn't make sense for them to work, you're going to have a loss in tax revenue in this current period. You're also going to have a loss in savings, right? Savings for the future period as well, because when we work, we generate tax income. That tax income goes for Social Security, which is savings for future generations, right? And so that also has an impact on savings for those individuals who are retiring, right? Okay, chapter 20. This chapter is on optimal taxation. What are the trade-offs involved in designing a progressive income tax system? All right, so again, I think an optimal taxation is kind of an oxymoron because it's almost something that doesn't exist, but because it has all to do with trade-offs, right? So what are the trade-offs of a progressive tax system? Well, understanding that when we talk about the U.S. tax system or a progressive tax system, it's really a theory of the second best at play here, right? We understand that there is no system of a tax system that will be Pareto efficient in not making somebody else worse off, right? So we understand that the idea of the theory of the second best, but at the same time, we try, even though we understand that we won't be able to achieve a Pareto efficient tax system, we still seek for a Pareto efficient tax structure. So find the best possible structure. A progressive tax structure seems to be the preferred one, the structure that gives us the best chance at a Pareto efficient tax structure. Okay. The problem is that progressive taxes also often lead to greater deadweight losses. Okay. Just simply because of the nature of the progressive tax, right? You have those that make more, or as you make more money, you pay more in taxes. So there seems to be an inherent perverse incentive in there, right? The incentive is not to work as long, not to work as hard, or to try and cheat on paying taxes, because again, the more you make, the more you pay. So that progressive tax system is inherently producing a perverse incentive. So what tax systems have tried to do is to think about other ways where we can make the system more equalitarian, so to speak. And this idea, the more equalitarian approach, does prefer progressive tax systems over regressive tax systems, even though progressive tax systems do generate these great losses, these great deadweight losses, but they also, by nature, do place the burden on those that make more money and thus have a greater ability and opportunity to pay more in taxes than those that do not. What should be the role of the taxation of commodities, such as luxuries, for example, and savings in achieving greater equity and in taxation? Well, if you're taxing something like a yacht, right? Tax on a luxury yacht, a $20 million luxury yacht. Nobody is going to complain about that being unfair, right? Those individuals that can afford that type of a commodity, that type of a product, will simply pay for it, and it's over and done with. But when you think about other commodities, right? Any tax on a commodity increases. As the tax increases, the deadweight loss increases with the tax rate. So the higher the tax rate, the higher the deadweight loss. And so it's almost impossible to get around that negative impact. You also have, when you think about taxing income, for example, you look at the revenue function, right? You assume here that on the horizontal, if you have the revenue at the bottom, right, and the tax revenue at the top, tax revenue on the left-hand side, and the tax rate at the bottom, the higher the tax rate, so as you increase, as you go to the right, as you move to the right, the tax revenue increases. But you notice that there is a point at the top of that circle, at the top of the semicircle, at the top of the arc, where you begin to have diminishing returns. This is kind of a Laffer curve effect, where tax revenue goes up with the tax rate, but at some point it begins to actually come down. And that has to do with people beginning to find ways to cheat on their taxes, find ways to avoid paying taxes, or simply stop working because it doesn't make sense for them to continue seeking work or seeking higher wages when the more they work, the greater their tax burden will be. And this again here, similar impact here. There's a deadweight loss. There's a deadweight loss from raising an extra dollar of revenue from taxing a commodity. So you see that the marginal deadweight loss relative to marginal tax revenue for a commodity, as you increase from say a tax TI to a tax TJ, you're only as you increase the tax, the result is an added loss in welfare to the system, to the economy. So in the end, you cannot escape the deadweight loss, the burden, the negative tax burden of taxation on a commodity, for example. If the government imposes taxes on different commodities, how should the tax rates be set to minimize the total deadweight loss? So, like I said, we understand that it is impossible to eliminate that deadweight loss. So, what is the best way then for the government to impose a tax, which ultimately it has to, right? Some kind of a tax needs to be imposed. So, what is the most preferred tax? And we find the answer to this question on this idea that we look at the objective of taxation, for example. What is the objective of taxation? Well, it's to redistribute income, right? and impose the burden on those that are most able to afford it, right? So that if that's the idea for taxes, if that's the justification for taxes, and in some ways the objective of the tax for income redistribution and imposing the burden on those that are best able to afford it, then should we then not be looking at income taxes? Because income taxes, contrary to commodity taxes or taxing a commodity, income taxes ensure the same tax rate on all commodities, as opposed to commodity taxes, which tax each commodity differently, right? And if you look at income taxes, right, say on contrary to say Ramsey taxes, which Ramsey taxes are those that say that in the absence of an income or a profit tax, and with all individuals identical, right, raising revenues so as to minimize dead weight loss, requires imposing taxes in inverse relationship to the elasticity of demand and supply. It means that Ramsey taxes are those then that suggest imposing taxes on commodities based on the elasticity of demand and supply of those products. The problem is that we don't know what those elasticities of demand are. Not all individuals are identical, okay? And so because we don't know these things, because of this asymmetry of information, the most efficient or the least burdensome way to redistribute income and impose the least amount of burden is through an income tax, which ensures that all commodities are going to be taxed the same way, as opposed to taxing one commodity in one way and another commodity in another based on the elasticity of demand or supply of those commodities. It would almost be, not only would it be very inefficient, it would be impossible for the government to be able to understand how every single elasticity of supply and demand for every single commodity works, but it would also create tremendous amounts of unfair taxation situations between one product, another product, the production of one product versus the production of another. So the best way and the most efficient way to do it is to simply tax the income, where you're essentially taxing the amount that is available for you to purchase whatever commodity you wish to purchase. Chapter 21, Taxation of Capital. What are the reasons why many argue that income from capital should be exempt from taxation? All right, well, a couple of reasons. Okay, the text provides a good explanation for this. Essentially, should income from capital be taxed? Okay. There are equity issues, there are efficiency, issues of efficiency, and issues of administrative simplicity. For example, an equity issue is taxing what you take out, not what you put into the system. So for example, if contrary to, say, a tax on consumption is a tax on what you take out, as opposed to what you put in. So a tax on consumption, whatever you consume, you pay a tax on. With income from capital, okay, this is what you are putting into the system, all right, because you are investing capital and there is something going into the system as opposed to just taking out. There's an efficiency issue too here. A consumption tax, for example, lowers debt weight loss because you assume that only those individuals who are wanting to consume that good or service are the ones that pay for it, not everybody else. And there's also the issue of administrative simplicity, the idea that it seems much easier to tax consumption taxes versus, say, income from capital taxes. What effect do capital taxes have on saving and investment? How can these effects be offset? Why are the effects different in a world with a global capital market? We'll look at the effect of tax on interest and investment by looking at the equilibrium here, the equilibrium between supply of savings versus demand for investment, right? And these two different markets, if you will, clear through one price, and the price of that is the interest rate, right? And so if you tax the higher, if you pose a tax on investment, if that increases the need for a higher return on investment. So imposing a tax on investment is going to have a detrimental impact on demand for investment, because what you're essentially doing is you are creating an additional cost of investment, which means the return on investment will necessarily have to be higher for you to engage in investing. And so that creates a deterrence for investment. On the other hand, so by doing that, you would substitute away from that and say, well, now if you're not going to invest, if I'm not going to invest, I'm going to either consume or save, right? And so you look at saving. So saving will then be positively affected by that increase in the tax. So if investors are investing less, demand for investment is less, therefore their return on those investments is less. And if that generates income for individuals, you look at the relationship between income and savings, which says that savings equals income minus consumption. If income is reduced, not only in this period, but in the next period, and consumption levels are remaining the same, then savings will drop also, because your income is lower. Even though consumption remains the same, then your savings will be lower as well. So it does have, taxes do have an incidence both on the investment in this period and as well as savings in this period or the next period. What effect do taxes have on risk-taking? Well, taxes have an impact, and they can work either way. They can go both ways, right? So capital taxation may increase risk-taking, okay? And they can also reduce risk-taking. And how does that happen? If the government allows individuals to invest in very risky assets, and through the tax code will provide a return from investment losses, right? Then what it does is essentially it's in some ways promoting individuals to take on more risk than they would normally take, because the government essentially becomes a partner for the investor, where some of those losses are going to be offset when the individual declares those losses from income, right? Investment losses. And so it generates a propensity for individuals to take on more risk than they would normally take. On the other hand, capital taxation may reduce the risk, because the way that the progressive tax system is built and the way that the U.S. tax system is, even though it does provide for some losses to be offset, it doesn't provide for all losses to be offset. And so still there's the tendency and the incentive for investing in more sound investments is still greater than the opportunity for investors to try and share the risk with the government, so to speak. Okay, focus question 21.3. Why do depreciation, capital gains, and inflation pose problems for capital taxation? How are these problems addressed in our current tax system? And what are some of the resulting problems? Well, one of the big problems with taxing assets is these distortions that arise from depreciation, right? Not all assets increase in value over time. In fact, an old truck that was used for production decreases in value, right? A factory depreciates, right? It gets old, rusty. Maybe the machinery gets old and rusty and does not perform in the same way that it performed when it was new, right? And so you have this asset depreciation that reduces the ability of capital to generate the same amount of gains, right? And so while the government does provide for these tax depreciation allowances, right, where you can, in fact, a business can quantify or determine how much of the value of the asset has in fact depreciated, it is not 100% foolproof. It is not 100% efficient or correct all the time. True economic depreciation is difficult to determine by the government. And there's ways also that businesses and individuals can sometimes get around the real value of their assets to try and reduce some of that tax burden. So what are some ways that we are able to find that efficient or that correct depreciation, right? How do we value asset valuation? How do we do it? Well, there's methods, right? We in accounting, you have straight line versus accelerated depreciation methods, right? So the straight line is the most common. You have the value of the asset, the book value, and then you divide it by the useful life, and you take away the salvage value, and you have an annual depreciation, right? And so if a truck that is used in the production or the delivery of goods and services for a firm, if that truck has a 10-year useful life, you would depreciate it over the useful life until its salvage value is all that remains. And then after that, you wouldn't pay any taxes on that asset. Sometimes, though, depending on the type of use of the asset, straight line doesn't work, or it's not the appropriate method. So you will use an accelerated depreciation method. Of course, there are times when you shouldn't use the accelerated method, but firms are still using it, and that creates distortions in the system, and it does create some efficiency losses as far as not paying the tax that should have been paid. There's also a problem with inflation. Inflation poses a problem too, because inflation, if you don't take out inflation, you might be paying taxes on nominal income that has been generated, right? But the real income, its real value, right, after inflation, is actually less, right? And so there is that inflation tax imposed on individuals, and we don't take that into account as well in our tax valuation as we should, right? And part of the reason is because we don't account for inflation in many of the things that we tax or we declare taxes on. Okay, so to summarize, again, as I said at the beginning of our presentation, this lecture was all about taxes and taxation. And I guess if there's one general idea about taxation is that it is an unsolvable puzzle, right? It is an unsolvable puzzle. There is no way to find a a tax that will meet all of the criteria of fairness, of efficiency, of equity, right? Because of the natural distortions that a tax produces, because of how it affects individuals differently, right? And because of the necessary trade-offs that are produced or that are required when we impose it, right? Pareto efficient tax allocations are impossible. Every single tax allocation will make somebody worse off, but we seek a progressive tax system because it seems to be the one that best allows us to redistribute the income and impose the burden of that tax on those that are most able to afford it. So those that make more income tend to pay more taxes in general. Okay? So that's the presentation for this week. I hope you enjoyed it. And as always, please let me know if you have any questions on this topic or any topic prior to this week. And as always, God bless, and see you next week. Thank you.